Hi, welcome to Samco YouTube channel. My name is Veer. In this video, we will be talking about SBFC Finance IPO, which is going to hit the market on August 3. Now, whether this hit is going to be a super hit or a crash hit is what we will try and understand in this video. Firstly, here are the key details of the issue. The IPO start date is 3rd August. The IPO end date is 7th August. The price band is Rs 54 to 57 and the lot size is 260 shares. The market value of this IPO post issue will be 6,066 crores at the upper price band. Now, SBFC Finance is essentially a non-banking finance company. Similar to banks, they give out loans, but unlike banks, they cannot accept deposits. So where do they get their money from? They borrow from banks, they borrow from other NBFCs, and they also borrow from the debt market. While studying and valuing a lending business, there are three key parameters which one needs to look at. Those three parameters are: number 1, who are they giving their loans to? Number 2, where are they getting their funds from? And number 3, where are they disbursing their loans at? We will use these three same parameters to study this IPO. Let's move on to the first parameters. Who are they giving their loans to? This is an important parameter to understand because this helps us in understanding 1, what is the market size and scope for growth. Number 2, how margin accretive the business is. And number 3, how risky their loan book is. If we look at the loan mix of SFBC Finance, we can see that the secured micro, small and medium enterprise segment constitutes 79% of their loan book as of FY23. Loan against gold stands at 17% and the other, which is nothing but the unsecured personal lending space, comprises of 3%. So there is a clear trajectory that the company has a big chunk of its focus on capturing the secured MSME segment. If we talk about the MSME market, there are 62 million MSME enterprises in India, which is the highest in the world. However, out of this, only 15% of them has access to some form of formal credit. Thus, we understand that this market is very huge and there is a scope of growing at a very higher pace. So now we understand that the market is huge and companies can grow at a high pace. But now, is this company, SFBC Finance, growing at a higher pace? As you can see that the company's AUM, yes, it has been growing at a very good pace. So in FY21, it grew its AUM by 34.77. In FY22, it grew its AUM by 43.7%. And in the latest financial year, that is financial year 23, its AUM grew at a very strong pace of 54.84%. Yes, it's on a lower base, therefore the growth might seem very high, but considering the potential of this segment, these numbers can be sustained in the medium term. When looking at the loan book, we also understand how the margins of a particular business would be. Now here we know that this company is into MSME segment. Now MSME as a segment is a very challenging segment to give loan to, and therefore a lot of banks don't prefer giving loans to this segment. Therefore there is a lot of demand but less supply. Therefore companies like SFBC who are into MSME space, they enjoy higher margins. But this company is also into secured lending, meaning less risky. Therefore the margins would not be very high. If we look at the net interest margin of this company as of FY23, it stands at 9.32%, which is somewhere in middle of its other peers. But now, as I have just mentioned, the company is into secured MSME. Secured means less risk. Therefore, as it is taking less risk, the asset quality should also be stable, right? So if we look at the gross GNPA of this NBFC, it has been on a declining trend. So as of FY23, the GNPA stands at 2.43%. When we compare the GNPA of SFBC Finance to its close peers, we can see that there is definitely a scope for improvement for SFBC, and GNPA might look a little higher than its peers. It is higher, but here we need to understand why it is higher. It is higher because this company has rapidly expanded across geographies in India. And when as a lending company, you expand rapidly and you move into a new geography, it takes time for you to understand the market, right? And therefore the GNPA in the initial years of understanding the market might come out as little higher. Now the second important parameter to look at is where is the company sourcing its funds from. This is an important parameter to understand because this would help us in identifying what is the cost of funds. Cost of funds is one of the most important metric to look at when you are studying a lending business. As we can see from the borrowing mix, as of FY23, 77.75% of the company's borrowings comes from banks, 9.8% comes from NBFCs and financial institutions, 1.15% comes from NCDs, and 9.7% comes from the other sources of borrowing. So here, you need to understand that higher the share of NCDs, the better it is, because NCDs provides borrowing at a cheaper cost of funds. So if your NCDs are high, your cost of funds would be lower, which is a good sign. However, to increase your share of NCDs, a company has to build a legacy for itself, has to provide its asset quality for some years. And therefore, as the SBFC Finance would grow older, would provide a legacy, would prove its legacy, its share of NCDs would also grow. So we can see that the company's cost of borrowing is at 8.3%. As I've mentioned previously, as the company would grow its legacy, its NCD shares would increase, and its impact would be on its cost of borrowing, which would also come down. The third parameter to look at is where is the company disbursing its loan at. When you are in a lending business, or matter of fact any business, you don't want a large part of your revenue to come from a single state, because any problem in that state, any crisis in that state can significantly damage your business. We saw what happened in the case of Bandhan Bank. Its overexposure in few states cost the bank badly. So now, is this NBFC geographically well diversified? As we can see that the SBFC Finance has a presence in 16 Indian states. It has 2 union territories with a total branch of 152 across the country. So yes, we can see from the graph that the company is fairly spread out across states. It is geographically diversified. So that's a thumbs up. Now finally, the big question, should you subscribe to this IPO? The company works in a segment that has a very big market. Additionally, the fact that this company has spread out its presence across the states gives it an edge over its peers. Through this spreading out across geographies, the company can actually grow higher for longer. The company's price to book stands at 3.51x, which is surely not cheap. However, considering the segment, considering the healthy macro environment, the healthy loan book, and the experienced management, we recommend our investors to subscribe to this IPO for a long-term perspective. Hope you enjoyed this review and learned a thing about the lending business in general. Do share your feedback in the comment section, like our video, and subscribe to our YouTube channel. Thank you.